Key point 1. Investing is simple if you take the time to learn it. Benjamin Graham, the father of value investing, strove to teach and inspire young investors to invest thoughtfully. Jason Zweig also lends his voice in echoing these hard truths and channeling them to the investor of today's market. But do you have to be a financial genius to become an investor? Not at all. However, you might become one by developing specific skills and learning more about investing. An investor is any person or firm that commits capital to obtain financial returns. Investors rely on different financial instruments to earn a return rate and accomplish important monetary objectives, like building retirement savings, funding a college education, or accumulating additional wealth over time. An investor is an individual who takes calculated risks with hopes of financial return. An investment is an asset bought after careful research to generate an increased monetary return or appreciation in the future. Benjamin Graham and Jason Zweig go deeper and offer more insight into investing. Let's look at two terms commonly used in stock exchange trading. An investment ensures the security of the invested capital and the promise of profit. Speculating neither assures the safety of your money nor your profit at the end of the investment period. Thus, an intelligent investor is involved in ventures that will yield a long-term reward, while a speculator is more interested in what they can get in the short term. This summary will teach you to differentiate between these two categories of people and conduct proper research before putting your money out there. Most importantly, you will learn how to make the best choice when faced with multiple investment options. People who invest make money for themselves. People who speculate make money for their brokers. Benjamin Graham. Key point 2. The intelligent investor makes decisions based on ample research to avoid incurring losses. Investments are a matter of character and soft skills. Success in investing is not about the level of your IQ or SAT score. More than anything, you need patience, discipline, a desire to gain knowledge, and emotional intelligence. Intelligent investors also observe the company whose stocks they want to buy, study the history of gains and losses, and protect themselves from financial damage before investing. They have long-term goals and know better than to speculate, so they invest in stable stock returns. Investing seems sensible for any individual seeking to build and sustain wealth, but the stock exchange giants on Wall Street profit more from speculation. They do this by downplaying investing as a means of making wealth. The speculator is prone to making rash decisions and trying out tactics that have recently worked. But like in gambling, the house always wins in the end. Gambling houses sell the allure of speculation because they have calibrated the odds to their favor. Then, unsuspecting, money-hungry individuals dump their capital and expect to cash out big, only to be disappointed. Gamblers pray for luck. Intelligent investors take calculated risks. Investment is a sure thing. It works now and will work long after. The intelligent investor knows this and stays ahead of the market. But what happens when the market suffers a setback or an unforeseen glitch that makes it harder to profit? How does the intelligent investor deal with inflation? It is time to learn about this process and how it affects the market. Inflation is an instance where the value of money drastically reduces, usually due to an increase in the printing of money or a large influx of cash into the market. This occurrence affects the market significantly because whatever shares you bought would have reduced in price, and you would have stocks with poor monetary value. How do you survive this as an investor? The obvious advice is to buy more stocks and invest more in shares when the cost is low. When the market heals, you will sell them at a higher monetary value. Key point 3. The intelligent investor makes wise decisions to stay ahead of the curve. Another important concept in investing is in bonds. A bond is a form of a loan when an investor lends money to a particular borrower in return for regular interest payments. Investing in bonds might be a sound and sure way to evade the stock market's inconsistencies, but there are sides to it that might prompt you to exercise caution. If your only interest in investing in stocks is the cash profit, you risk losing it. The intelligent investor should consider it a passive option, not a principal obligation. They can invest in foreign bonds, offerings from countries abroad, but if they are willing to take on much more risk than previously encountered. Bonds are an alternative investment option, but you should buy them cautiously to avoid any blowback. The average investor tells you to invest in every startup's initial public offering, or IPO. But this is speculative and does not guarantee positive returns. Unless you can pick every startup that will become successful, you risk losing a lot of money. The intelligent investor knows which IPOs to invest in. They're not plagued with the guilt of missing out on a successful startup, when less experienced investors might panic in such a situation and support the next big thing, leading to loss. Investors who make decisions without adequate research almost always set themselves up for failure. The usual practice is holding stocks, selling them when they become overpriced, and finding shelter in bonds until another price dip. But the intelligent investor knows this is an impractical plan because it's almost impossible to predict when the market will experience a drop or rise. Because of this, Benjamin Graham and Jason Zweig urge investors to diversify their portfolios. But as you seek to diversify, it's not advisable to indulge in foreign stocks because it would mean you were robbing yourself of the security offered by your country's currency. Did you know? The first recorded speculative bubble in history is considered tulip mania. This phenomenon occurred in the Dutch Republic from 1634 till 1637, when contract prices for some luxury tulip bulbs drastically increased and then fell sharply. Contemporaries claimed that many investors were bankrupted by then, but modern studies believe this story is not as severe as widely accepted. Key point 4. Becoming an investor involves a lot of research and practice. No training or certificate qualifies you as an investor. The layperson can become one with the right amount of research and guidance. Anybody interested in trading stocks and funds can do so without fear by following Benjamin Graham and Jason Zweig's advice. These are steps to follow if you strive to become a successful investor. 1. While picking a particular company to invest in its shares, look at its long-term goals, the plans they have for its future. 2. Consider the quality of the company's management. If it focuses on paying the owners or managers huge sums, you should not invest there. 3. Pay attention to the company's financial strength. If it's not stable, you might make a financial mistake from which it will be harder to recover quickly. Additionally, it would be best to explore the company's dividends per fiscal year in the current dividend report. If you need more specific considerations before choosing a company to invest in, the following should be helpful. Avoid companies with a total market value of less than $2 billion. Go for companies whose current assets are twice their current liabilities. The companies must have expected stock earnings for at least 10 years. The companies must have consistently paid dividends for at least 20 years. There must be a minimum increase of at least 1/3 per share earning in the past 10 years. The company's share price should not be more than 15 times the earnings of the past 3 years. The investment business requires a keen eye and a willingness to dedicate to lifelong. With these tools, anyone can navigate the uncertain waters of the stock market, make maximum profit, and minimize risk with the defensive investor's approach. While it may seem too complex a concept to wrap one's head around, investing is easy if you're determined and committed to research and practice. Invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Benjamin Graham. Key point 5. The enterprising investor is an intelligent investor and a risk taker. The rational management of your income allows you to create your own investment capital, which will constantly bring a certain profit. In other words, you'll make your money work for you. There are two types of investors: the enterprising investor and the layperson or the defensive investor. The standard guidelines for picking winning stocks will not cut it for the enterprising investor fearless in taking significant risks. They would have to employ a new set of measures that engage this investor's activity level. Unlike the defensive or layperson investor, the enterprising one is more involved in running their portfolio and actively monitors the investments they make, periodically tweaking the setup. Rebalance your portfolio every 6 months so that you can make up-to-date, reasonable investment decisions. It will also allow you to be in control and align a portfolio with your current goals. The following are a few ways to secure the most profitable stock options for the enterprising investor. The first step is to practice. They can start by monitoring the market, picking out the winners, and keeping tabs as though they were banking on them with actual money. Always go for companies run by the owners, not the managers, because there's a higher chance they'll do business for the general good of both them and their investors. It would be best if you keep an eye on the yearly earnings. Do not let the business owners fool you. Let the business numbers do the talking. It is imperative to keep an eye out for the company's health and financial power. That way, you're sure of getting a profit when you invest long term. The enterprising investor can also get convertible bonds and convert them into stocks and other securities. These kinds of securities offer the holders an option to diversify their portfolios. Also, they provide if either of the fund's prices dips and loses worth. These convertible stocks outperform regular stocks and are a reliable option for the enterprising investor who's not down for getting stuck with an underperforming stock option. It is like copying and surpassing the current market. But if the stock it's mirroring does poorly, it will do even worse. This multiplier effect is one disadvantage of owning a convertible bond. Key point 6. The intelligent investor picks the best deal from the multitude of options. How do you know which stocks to buy? And what do you do when you're about to make a mistake? Benjamin Graham and Jason Zweig compared similar yet different companies and identified why and how investors might be drawn toward investing in them. Investors can move to invest in a company's stocks because it appeals to their emotions. The company's slogan or a catchy ad might evoke a pleasant feeling, or they might associate the company's values with a fond memory. It is a wrong move. Investors should never let sentiment influence their decision-making. Emotionally driven decisions can lead to a bad investment. You can claim to have found a pattern on the market because of a few lucky guesses. It's important to note that this is false and can be detrimental to investors. There's no perpetual gain. Public opinion can also form or influence individual opinion. Simply because a company is hailed as groundbreaking does not mean it is. Do your research and don't yield to peer pressure. The intelligent investor must realize that even the analysts can be wrong, and they might be better off taking the words of the business owners instead. Certain companies declare their inability to turn in profit now and have difficulty doing so in the future. If you were to observe the market diligently, you would see the performers at first glance, but look closer. The numbers can lie, or at least mislead. The initial evaluation of a company might not truly reflect its actual success, and it is not an indicator that it will do well in the next 5 years. Go for the less glamorous companies that produce steady returns. Even though they're not in the billions, they're on the rise and undisturbed. Invest in the proverbial dark horse, not the shiny white horse. It might be a red herring. Knowing the basic rules of value investing will save your portfolio and allow you to increase it gradually. After all, investing is the art of taking the proper steps at the right time. Conclusion. Investing might seem like a drag because its dividends usually take too long, but it sure beats dumping your money on any get-rich-quick scheme. The chances of getting a good return on speculation are 1,000,000 to 1, but with investment, your capital remains unchanged and you gain a profit. To effectively hone your skills as an investor, you must approach them with attentiveness and an avid desire to learn and take expert advice. The intelligent investor can be anyone. If you use your tools right, it can even be you. Investment is not some magical act that requires unique spells or equipment. It is also not reserved for the elite. In today's fast-paced economy, investment is a crucial part of wealth creation, and every individual should consider owning stock. Many current investors are stuck in one kind of problem or the other because they're mismanaging their portfolios. This is why you might encounter someone with a packed portfolio who still ended up broke. Make sure to research extensively before investing in any stock. To avoid running at a loss, ensure you are armed with ample data supporting your decision rather than just feelings. Being an intelligent investor is far beyond simply investing or researching. It is the ability to pick out favorable stocks and know when to invest and when to sell. Try this. If you haven't considered a viable retirement plan, Look at stocks and bonds you can invest in today. You can also research the shares offered by top brands and purchase the best fit for you.